Chapter 2, Theory Base of Accounting. So where the first concept we have is Generally Accepted Accounting Principles, where it is also termed as GAAP, which stands for Generally Accepted Accounting Principles. So here the Generally Accepted Accounting Principles refers to the rules or guidelines adopted for recording and reporting of business transaction in order to bring uniformity in the preparation and the presentation of financial statement. The basic concept of Generally Accepted Accounting Principle is to bring the uniformity in the process of recording and reporting the financial statements. So here the financial statement is nothing but the accounts which were prepared by the organization, where there should be a uniformity for all the accounts or the financial statements prepared by the organization. So where it should be very easy to compare with one organization to the another organization. And coming to the government authorities, like we can take income tax department, where if they want to analyze the profit of the organization, when each and every organization is following the same accounting practice, at that time it will be very easy to analyze the profits of the organization, so that the generally accepted accounting principles to be followed by all the organizations to maintain the uniformity in preparing and reporting the financial statements. The second concept we have is accounting concepts. The term concept refers to the assumption and ideas which are fundamental to accounting practice. So accounting concepts are the fundamental ideas or basic assumptions underlying the theory and practice of accounting, and are broad working rules for all accounting activities. The important accounting concepts are business entity concept, where the first one is business entity concept, which is also known as separate entity concept. In accounting, we distinguish between the business and its proprietors, because it is assumed to have distinct entity and we have to record business transactions from business point of view and never from the point of view of proprietor. So where coming to the business entity concept, where business is a separate entity and ownership is a separate. So where ownership accounts, whatever the owner is using for his personal need, that will not be recorded in the business transactions, and the business transactions will not be recorded in the proprietor's accounts. The second thing we have is money measurement concept. So coming to money measurement concept, it means that in accounting a record is made only of those transactions which can be measured in terms of money. So where coming to the business organization, we are going to record the transactions which are measurable in terms of money. The transactions which are not measurable in the terms of money, we cannot record in the books of accounts. Next concept we have is going concern concept. The going concern concept means that in accounting, as enterprise is regarded as a going concern, that is a concern that continues to operate for an indefinitely long period of time. So when coming to the business organization, so we can take that multinational companies or a joint stock companies, where they are not meant for 1 year, 2 years or 3 years. A business entity will be meant for a long period of time. That's why the accounting concept we are going to consider here is going concern concept, where this particular years of accounts can be used for the next year for the analysis and interpretation. So by keeping that in mind, accounts will be prepared for each and every year, as the business is a going concern concept. The next concept we have is accounting period concept. The accounting period concept comes from the going concern concept. Under going concern concept, the financial result of a business can be ascertained only on the liquidation of the business. The accounting period concept means that for measuring the financial result of a business periodically, the working life of a business is split into convenient short periods of time called accounting period. When coming to the accounting period, either we are going to follow the financial year or we are going to follow the calendar year. So coming to calendar year, it starts from 1st Jan to the December 31st, and coming to the financial year, it starts from 1st April and ends to the 31st March. So coming to the business organizations, in the present scenario, each and every organization is following the financial year. The next concept we have is cost concept. The cost concept means that an asset acquired by a concern is recorded in the books of accounts at cost or purchase price. The market price of the asset is ignored. So coming to the business organization, whatever accounts we are going to maintain, the transactions we are going to record only on the cost basis. So when coming to the cost concept, we are going to consider only the cost price. We are not going to consider the market price. So now let us take one small example. If we are purchasing a machinery for 5 lakh on 1st Jan 2017. So now if the same machinery is costing on 1st October 2017, in the market it is costing only 4 lakhs. So we purchased for 5 lakh, on the later on date it is 4 lakh in the market. So nowhere we are going to consider the market price, which is 4 lakh, we are going to consider only the price which we have purchased, which is 5 lakh. It means that in accounts we are going to record the cost price, we are not going to record the market price. Now we can take one more example. The machinery was purchased for 5 lakh from the market. So now on 5 lakh rupees we have incurred transportation of rupees 20,000, and for erection of the machinery we spent 30,000. So the total cost of the machinery will become 5 lakh plus 20,000 for transportation and 30,000 for erection. So the total cost of the machinery will become 5 lakh 50,000, and the market price is 5 lakh. In accounts we are not going to record 5 lakh, we are going to record 5 lakh 50,000, which is inclusive of expenses and the erection charges. The next thing we have is dual aspect concept. So coming to the dual aspect concept, it means that every business transaction have twofold effects, that is receiving of benefit of some value and giving of some other benefit of equal value. So where the dual aspect concept is nothing but we will be having twofold effects. For example, we are purchasing machinery for 5 lakh 50,000. On the other side, we are paying 5 lakh 50,000 for that machinery and we are taking the machinery. So each transaction will be having two effects. For example, we can take one more example. If goods sold for rupees 50,000, so one side we are giving goods for rupees 50,000, on the other hand we are receiving 50,000 in terms of cash. Then the seventh concept we have is revenue recognition concept, which is also called realization concept. This concept states that revenue is earned from the sale of goods or from provision of services to customer, and revenue is said to be recognized or considered to be realized only when goods or services are transferred to the customer and customer becomes legally liable to pay for them. So here the profit or the revenue should be recognized only when there was a complete or completion of the transaction. So when there is a incompletion of the transaction, we cannot consider the revenue out of that particular transaction. If we are selling any goods, out of that we are going to get the income. So when the goods are not completely transferred to the particular customer, at that time we cannot ascertain the profit out of this particular sale. The next concept we have is matching concept, or we can call it as matching expenses and revenue. Reasonable profit is the object of every business enterprise. The whole business structure is based upon the desire to earn profit. Profit is the result of two factors, namely revenue, which is also called as income, and expense. So for the measurement of profit or loss, these two factors are matched or compared, and resultant balance is taken as the net profit or the net loss. So matching concept is nothing but this year's expenditure we are going to match with the revenue of only this year. Next year's expenses we cannot consider and we cannot deduct out of the current year's profit. So now let us take the small example here. If we have profit of 50,000 and we have rent which is prepaid. So where the rent is for the next year, we have paid in advance of 20,000. So this year profit we have 50,000, and this 20,000 prepaid rent what we have, we cannot deduct from the profit of this year. This will remain as a asset, where next year it will be deducted from the profit. This year profit will be there as it is 50,000. It is not going to be deducted from the expenditure which is meant for the next year. And the next concept we have is accrual concept. The accrual concept states that the further consequences of a transaction arises when a transaction is entered into books of accounts. So all transactions must be brought into record, whether they are settled in cash or not. This concept have given rise to the introduction of the accrual system of accounting as against cash system of accounting. The next concept we have is objective evidence concept. Objective evidence concept means that all accounting entries should be evidenced and supported by source document or business documents such as invoice, vouchers, bill, receipt, etc. And no transaction should be recorded in the books of account without such documentary evidence. After completing accounting concepts, the next concept we have is accounting conventions. Accounting conventions are the customs, traditions or practices which are followed by accountants as a guide in the preparation of financial statement of a business enterprise. When coming to the accounting concepts, we have some of the important accounting conventions, which are convention of materiality, convention of Convert Ism, convention of consistency, convention of full disclosure. Now let us take one by one and we will try to understand what is convention of materiality and the different conventions. Where the first one is convention of materiality. So when coming to the convention of materiality, according to this convention, in accounting, detailed record is made only of those business transactions which are material, or we can call it as significant to the user of accounting information, and insignificant transactions are ignored. So it means that if the transaction is important, those transactions material will be maintained, and if the transaction is not important, we are not going to give preference for those transactions which are not important. And the second convention we have is convention of Convert Ism. The convention of Convert Ism means that the convention of caution or the policy of playing safe. In the accounting records and the financial statement of a business, all the prospective losses should be taken note of and provided for, but prospective profit should be ignored. For example, we value stock at cost price or market price, whichever is lower. The third convention we have is convention of consistency. The convention of consistency means that the accounting practices and methods should remain unchanged from one accounting year to another. For example, if the stock and investment are valued at cost or market value, whichever is lower, then the same practice should be continued for all the years. And the next convention we have is convention of full disclosure. The convention of full disclosure means that all materials and relevant facts concerning financial performance of an enterprise must be fully and completely disclosed in the financial statements and their accompanying footnotes. Now, after completing the conventions, we have system of accounting. The system of recording the financial transaction in the books of accounts is generally known as bookkeeping. It can be divided into two types, namely single entry system of bookkeeping and double entry system of bookkeeping. When coming to single entry system of bookkeeping, single entry system of bookkeeping refers to any system of bookkeeping which is not a complete double entry system. In other words, under this method, for most of the transactions, only one aspect of the transaction is recorded. On the other hand, we have double entry system of bookkeeping. Double entry system of bookkeeping is a method where both aspects of transactions are considered and recorded. So when coming to the single entry system, it is just an incomplete record of recording the transaction, and when coming to the double entry system, it is a complete system of recording where both the aspects are considered. So for example, when coming to the small traders, we can take the provisional stores or the medical stores or the small stores what we have. Those storekeepers will not maintain the complete record of books. So when coming to the provisional store, so hardly he can maintain the book, and where we will be recording only one aspect of transaction. For example, if he is paying the rent or if he is selling the goods, he will be maintaining the rough note. So those such of accounts will be considered as incomplete records or single entry system of bookkeeping. When coming to the double entry system of bookkeeping, we are going to record both the aspects, where every transaction will be having twofold aspects of recording transaction. For example, if the particular goods is purchased, where the purchases account will be prepared, on the other hand side what payment was made for that, the sales account will also recorded that, where the amount was paid for the purchases. Now let us see the features of double entry system of bookkeeping. So when coming to the features, first one we have is both the aspect of transaction are recorded in related books of accounts. So as I said, when coming to the purchases, we are going to record in purchases as well as in the cash book. And coming to the second feature we have is every debit entry has corresponding credit entry and vice versa. So same thing here, whenever the entry is recorded, one account will be debited and another account will be credited. Then the next feature we have is the debit and credit entries would appear simultaneously in two different ledger account on the opposite direction. So it means that whenever there is a transaction, we will be having two accounts and the transactions will be appearing in the two opposite sides. So where we can take one simple example here, where we can take a simple example. Mr. X started business with a capital of 2 lakhs. So here the capital account will be credited with 2 lakh and another side the cash account will be debited with 2 lakhs. So that is what the double entry system. Then the next feature is this method is based on dual aspect concept. For instance, total of debit must equal to total of credit. So this feature denotes that the total of debit should be equal to the total of credit. Then we have basis of accounting. There are two important bases of recognizing revenue in accounting from the point of view of timing of recognizing of income and expenditure. And these approaches are cash basis and accrual basis. So when coming to the cash basis, on the cash basis, income and expenses are identified only on the date of receipt or payment of cash, but not on the date of transaction. It means that when coming to the cash basis, whenever the organization is receiving a receipt, at that time only we are going to consider the income and expenditure. Again, whenever we are making the payment, so whenever there is a payment or the receipt of payment is generated, at that time only we are going to consider it as a payment. So where the transaction date is not considered and the receipt and payment date is considered under cash basis. When coming to the another method of maintaining accounts, which is accrual basis. According to accrual basis, revenue and expenses are recognized when they occur rather than when they are actually received or paid in cash. So in this method we are going to consider the revenue or the expenses when they occur and not when they are paid or not when they are received. As discussed in the previous chapter, accounting is concerned with recording, classifying and summarizing of financial transactions and events and interpreting the results thereof. It aims of providing information about the financial performance of a firm to a various users such as owners, managers, employees, investors, creditors, suppliers of goods and services, and tax authorities, and also to help them in taking important decisions. The investors, for example, may be interested in knowing the extent of profit or loss earned by the firm during a given period and compare it with the performance of other similar enterprises. Again, the supplier of credit, say a banker, may in addition be interested in liquidity position of the firm. All these people look forward to accounting for appropriate, useful and reliable information. So here what happens when coming to the organization, the accounting information whatever we used to prepare in the organization, it is not meant only for the organization. The information what we are going to prepare, it is also useful for the external users. So as we have taken the example of investor and the supplier. When coming to the investor, each and every investor will be willing to know the profitability of the organization to invest his money in the organization. Again, when coming to the supplier, so here when coming to the supplier who is going to supply the commodity or raw material to the organization on credit basis, so he will be willing to know the liquidity ratio of the organization, so that at the end whether he will get his fund or not. So whatever goods he have supplied on credit, that amount he has to get from the organization. By seeing the liquidity ratio of the organization, he can have an assumption that whether the organization will be paying or not the remaining balance. For making the accounting information meaningful to its internal and external users, it is important that such information is reliable as well as comparable. The comparability of information is required for both inter-firm comparison, that is to see how a firm has performed as compared to the other firms, as well as to make inter-period comparison, that is how it has performed as compared to the previous year. This becomes possible only if the information provided by the financial statement is based on consistent accounting policies, principles and practices. Such consistency is required throughout the process of identifying the events and transactions to be accounted for, measuring them, communicating them in the books of accounts, and summarizing the results thereof and reporting them to the interested parties. This calls for developing a proper theory-based accounting. The importance of accounting theory need not be overemphasized, as no discipline can develop without a sound theoretical base. The theory base of accounting consists of principles, concepts, rules and guidelines developed over a period of time to bring uniformity and consistency to the process of accounting and enhance its utility to different users of accounting information. Apart from this, the Institute of Chartered Accountants of India, which is the regulatory board for standardization of accounting policies in the country, has issued accounting standards which are expected to be uniformly adhered to in order to bring consistency in the accounting practices. These are discussed in the following section. So where we have generally accepted accounting principle. In order to maintain uniformity and consistency in accounting records, certain rules or principles have been developed which are generally accepted by the accounting profession. These rules are called by different names such as principles, concepts, conventions, postulates, assumptions and modifying principles. A general law or rule adopted or professed as a guide to action, a settled ground or basis of conduct or practice. The word generally means in a general manner, that is pertaining to many persons or cases or occasions. Thus, generally accepted accounting principles refers to the rules or guidelines adopted for recording and reporting of business transactions in order to bring uniformity. In order to bring uniformity in the preparation and the presentation of financial statements. For example, one of the important rules is to record all the transactions on the basis of historical cost, which is verifiable from the documents such as cash receipt for the money paid. This brings in objectivity in the process of recording and makes the accounting statement more acceptable to the various users. The generally accepted accounting principles, here the principles have evolved over a long period of time on the basis of past experience, usage or customs. Statements by individual and professional bodies and regulation by government agencies and have generally acceptability among most accounting professionals. However, the principles of accounting are not static in nature. These are constantly influenced by changes in the legal, social and economic environment as well as the need of the users. These principles are also referred as concepts and conventions. The term concept refers to the necessary assumption and ideas which are fundamental to the accounting practice, and the term convention connotes custom or tradition as a guide to the preparation of accounting statement. In practice, the same rules or guidelines have been described by one author as a concept and by another as a postulate and still by another as convention. These at times becomes confusion to the learner. Instead of going into the semantic of these terms, it is important to concentrate on the practicability of their usage. From the practicability viewpoint, it is observed that the various terms such as principle, postulates, conventions, modifying principle, assumptions, etc. have been used interchangeably and are referred to a basic accounting concepts in the present chapter. So when coming to the generally accepted accounting principles here, it is nothing but the principle where each and every organization have to follow to prepare the accounting reports in their particular organization. And even we have accounting standards, so where each and every standard will be describing that what type of account and how we are going to maintain in the organization, so that it will be very easy to compare the information of one organization to the another organization, and the language or the process of preparing the accounting reports will be unique all over the organization, so that the external users will understand the reports which is prepared by the organization.